Well, they turned them down a little. They might be doing a little more. Somebody was,
Well, if I hit 5, all the senators go off and everything else stays just like it is.
they were talking, somebody said, yeah, Russell said you turned down maybe a little more than good.
It's 10 o'clock. There we go. Really. Good morning. Morning. Thank you. I think it's morning. I think the sun went down, and maybe that'll make it so we can see the screens a little bit better. Wouldn't want to miss anything, right? And I'm so pleased to be here. I'm Gordon Shoger, and I'm the CFO. I've been here about 9 years, and I just want to thank you all for coming to this Director's Dialogue. And this year, as you can tell, someone told me how to spell dialogue. It actually has a U and an E on the end, and somewhere in English history, they started spelling like that. We're still doing it now. But I just have to say, I have no prepared remarks, so everything you're going to hear is just right off the slides and whatever comes in this little mind of mine. So it could be interesting, right? So one thing I do want to say up front, though, is I want to be especially thankful to all the residents of the ARC for their generosity. The Smith Fund almost broke $600,000 this year, and yes, and we'll get there next year for sure. It somehow it grows every year, and I think the average check this year was about $14.78. It's all based on hours worked for each employee, not how long they've been here, because they got a check somewhere in the past too, but how long they worked, how many hours they worked in this past year. And the only people excluded are people like me and the other directors. We're not included in the Smith Fund distribution. So we want to thank you for that. Also, the Kiwanis raise many thousands every year as scholarships for our employees, and we're very grateful for that. We've got several people in leadership positions that have been through that program and got their degrees, advanced degrees and other degrees, CNAs and everything else through that program, so we appreciate that very much. So on to the unprepared remarks. I'll start with a little bit of history about me. If you haven't heard it before, I'll bore you with it again. I've been here 9 years, and I've been here in senior living almost 30. I started in senior living in '96, and I think Bill Clinton was in the White House, if we still remember Bill Clinton. Yeah, we do, some of us anyway. I remember my earliest memory is when Kennedy was assassinated. I was very little. I was about 5, and my sister was crying, and nobody really could tell me why, or they couldn't understand. And then all you get on TV was clop, 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 the caissons of the horses through. Many of you, I'm sure you all remember that. That was on all 3 stations. Out where we lived, it was on the station. But that was a very sad, terrible time in our nation's history. But in senior living, I've worked for obviously the ARC for I've been here more years than anywhere else in my career, and I've worked for for-profit, nonprofit companies, big companies, little companies, national companies, companies you've never heard of, companies that have now gone away as the industry has changed. But I would say that I appreciate the nonprofit industry in senior living because what we do and we generate here for income, it stays here. It was always a problem to me to see so much money go to the corporate office, go to corporate bonuses, go to corporate expenditures, which didn't seem to be very wise in many ways, rather than stay at the community and support the people who live here and work here. So I appreciate that about the ARC especially. And I'd like to start off with introducing some of the folks in my department, all the folks in my department that are here. There's Lisa, Diane, Larnie, Brenda, Kelly, and then myself, and then we have a picture and Lisa will stand. And thank you, Lisa. Yes. We've been practicing the Princess Wave when you stand, so we'll see if we can get that down. Lisa's been here since 2013. As you can see, some pretty impressive numbers every year. Revenue, 45 million, and all the statements and the resident charges and everything else. This doesn't begin to explain everything that Lisa does because she is an expert on so many different subjects of everything that comes through finance, and we appreciate her so much. The next one is Diane, and Diane is not here because she's in Britain. And she was here for about 10 years, and then she went back to her home country to take care of her parents. And but she works through the internet, and she works remotely, yes, and does payroll for us, just like she did here when she was here. So as you can see, there's quite a bit of volume goes through her desk across through the miracle of the internet, and we appreciate her very much. She's 6 hours ahead, so she gets a jump on all of us, what we get done. Next is Larnie. Please, Larnie. Okay. And she does accounts payable, Larnie Graham, and she's been here. She started just a couple weeks before I did, actually, back there 2017, 2016. As you can see, the volume of checks and invoices, capital projects that she manages all the way through, and expenses. So she's a key part of getting everything done in the finance department. And we have, next is Brenda. And there's Brenda. Yes. She's been here since 2019. A lot of you know her from her role as customer service, and she continues in that. And as you can see, we have a good triage system with upset residents, and Brenda does a great job with working with those folks. Not that we have many upset residents, a few, but the thing is about finance, we don't get many social visitors, really. I mean, if somebody comes to finance, there's probably a reason, and it's got a dollar sign attached to it. So there's usually some emotion attached to that dollar sign, I will say. I'm not sure why, but anyway, so that's a good part of it. Brenda's been here quite a while, and she's an integral part of our team. And our newest member is Kelly. Kelly? Yes. And you can see from all the things that she's covering, and she's been a great addition to the team, almost a year at this point, and she was in resident services before that, and at the front desk. And so she knows a lot of you without having to figure out who you are. Maybe she knows your voice or the phone. But she does a great job with, like I say, Resident Smile is 100%, and the work orders, statements on the portal, resident calls. We didn't have the bandwidth before, but after we added her, we do our best to try to pick up the phone when somebody calls. So, like I say, that's a customer service, I would say, a big win for us. When I stood here a year ago, that was problem number one, and she's helped us solve that problem number one. So thank you, Kelly. This is water with a lemon. It's liquid, yes, some sort. Next, some other things that we do in finance, and you'll see this as the days cash on hand. We'll talk about that a little bit later, but as of September 30th, we had 271, and that translates into 29.6 million of investments and other operating money that we have on hand. It takes about 109,000 every day, and that's how you get that number. Is you take we spend about 109,000 every day, and it takes that much money to operate, pay our bond interest and everything else. So you divide that into the cash reserves that we have, cash and investment. Most of it's in investments, and it's been doing quite well in the stock market. Then the other parts that we're looking at here is budgets, and we talked about this past summer, the operational budget and then the capital budget of everything that's spent outside the operational realm of our spending. And then insurance management is also falls to our office. And we have, as we've talked about in the past, seen some radical increases over the last few years. It's fairly leveled off now, although employee benefits, employee health has continued to rise, as you've probably read in the news. And we don't escape anything like that just because we're here in San Antonio on 138 acres by ourselves. Everything that happens outside the gates still affects us, especially financially. So what's next? What else do we do in finance? We have the Emma report. And if anybody can name those in order for me, there's a special prize at the end of the meeting. But every quarter we report on three beautiful actresses and what they're doing and where they are and how and if they might come and visit us here at the Ark. But people ask about what is the Emma report. Well, before we get there, we'll diverse a little bit to a different Emma, a little more in history, the famous Emma Lazarus, who wrote the inscription at the bottom of the Statue of Liberty, "Give me your tired, your poor, your huddled masses, yearning to breathe free." And there's a picture of her as they took pictures in the 19th century. So just grateful to her and her words that welcome people to the United States. But a little more seriously, what is the quarterly Emma report? It's our financial statements. We could issue them without calling it Emma, but where does it go? It goes to electronic municipal market access. Municipal market access, and that is a free website with data about all municipal bonds and nonprofits like us that issue those bonds. So that is required by the bond covenants that we report all of our quarterly data. It has everything from the operating rate to the days cash on hand to the debt service coverage to our full financials, and we report that on a quarterly basis out there. So a little bit of background about what we do as a whole at the Ark. Some of these next few slides were part of a board education that we gave to the Ark Board of Directors, a special assignment to talk to them about really the nuts and bolts of what happens at the community. And I know everybody who lives here is probably an expert, but there's a lot of things that we do and all over the campus that maybe you don't realize. And a lot of people, when they come in through marketing, they want to know that we have nursing, but they don't really want to go look at nursing. But it's there for all of us, for all the residents to move through the continuum. So in a life plan community like us, it has at least three of the levels of care: independent living, assisted living, and nursing. And you're all, most all of you, I believe, are in independent living here that are here today. And that's as independent as possible, but still within the confines and the support of the overall system and the community. And we have assisted living, which is an interim step between independent living and skilled nursing, and what all that entails with additional ADLs, activities of daily living, as support. Sometimes medication management is the most important there. And then on to skilled nursing and rehab, of which we have Medicare and TRICARE as two major components of that as far as payer sources. But other than that, it's private pay. And it's for folks that are sick back from the hospital, or are just not anybody in nursing is feeling good and they're not feeling well, and they've had some sort of health issue. So we try to take compassion on those folks and do everything that we can for them, yet still get them back on their feet. And a lot of times they come back and they go back to independent living after a short stay with rehab. All these also are payer sources. Did I forget to mention that part? And as you can see, here's the levels of care by number of residents as of a couple of weeks ago, a few days ago, and where they are: memory care, nursing care. And one thing that the air is just really dry in here today. I'm not sure why. But one thing that I always mention about this is when you look at the industry as a whole and you look at other communities, I've worked at communities where it was one-to-one independent living and nursing. What that means is that community is going to have to pull in a lot of people from outside to stay viable, to fill those beds. But we are able to, because of our ratios, at 6 to 1, 6 to 1.2, whatever it is, as far as assisted living and nursing, those are good ratios because it means that we can feed from our independent living folks into the higher levels of care without having to rely on the outside market nearly as much as most other communities have. And that's a very healthy situation. Next thing that comes up is, and we get questions, well, what's the revenue? Where's our revenue come from? And these are listed pretty much in order of there's entrance fees is the main one as far as actual cash coming in, monthly service fees and monthly assisted living fees, monthly private nursing fees, Medicare TRICARES per day, and then dividends and interest on the investments, which is a big help as the stock market is successful. So we have a pie chart, and I know I owe someone in here probably a pie chart, and I'll try to get that to you later, a pie chart of revenue and expenses. And but it just shows that relationship of when we have the most of the revenue coming in through monthly service fees, and then the other fees as different percentages below that. Then our expenses, if we put bond interest in this, it's also pretty much in order of magnitude here with salaries and benefits and utilities, food, everything else that goes into running this place. And we have what that looks like with salaries and benefits at 51% if you include bond interest. Now, if you don't include bond interest, that'll be the next slide. So we have Medicare at 3.7. That corresponds to all the different folks in Medicare and TRICARE services and the direct expense that goes with that. And this next slide is excluding bond interest. So if you exclude bond interest, it's almost 60% now salaries and benefits. So we've seen that creep up over time with a higher percentage of our expense load going to all the people that work here. And I don't mean that in a demeaning way, but we would not be open without them, and we wouldn't be taking care of people in assisted living, independent living, or nursing care without those people to do the work. So that's a big part of our business. Can we go to the next slide? And this and I'm going to try to move along a little bit faster. We'll have time for questions at the end, hopefully. Depends on how long I take on each slide and how fast I talk. But we'll have time for questions. Right, Steve? Okay. This is just a very straightforward, how do we get an operating rate? What does that mean? Because it comes out every quarter in the Emma report. We talk about a lot. We budget to a certain operating rate. But just if you had a very small community with only $1 million of revenue and you had expenses at $1.5 million, $1,050,000, you're 50,000, that would put you an operating rate of 105%. It's just that simple equation right there. And what that means is if you're over 100, you're spending more, like here, you're spending more than what you're taking in. Another slide. Another thing that we talk about quite a bit is days cash on hand. And what does that look like? Well, that means our operating expenses, like we had in the first slide, of $1,050,000. And we have, in this particular small community, they have $1,001,000 in unrestricted reserves, cash and investments. And that, you do the math on that in the division, it's how many days of the year, 365, you divide it into your yearly operating expenses, and you have 2,877 in this case that they're spending per day, and you divide that into the amount of cash, so you get days cash on hand. Just for a factoid, our bond covenants are 120 days cash on hand. We've never been anywhere near that, or that low ever, I think, in the history of the ARC ever. Next slide. You've seen this slide before, so I kind of like it. It shows what we deal with every day as far as expenses. Is inflation, you can see, took off in 21. It's come back down now, as you probably follow that in the news. Come back down in the twos somewhere. But many of you remember, I'm sure, like I do, what happened in the 1980s and inflation that took off. And it wasn't just an on-off thing. It wasn't like you could turn a switch. It wasn't like you could get a different administration in the White House or the Congress and you shut it off. Once it took off, it takes a long time to bring it back under control. So one thing that we look at here is labor rates and in the market around us. Those have tapered off a little bit from their high increases we saw in previous years, but they're still strong, and we still have to compete. To everybody that works here could go somewhere else and get a job, maybe a better job, and they stay here because they're a lot of times, almost without fail, folks stay here because they have a duty, they feel a duty and an honor and a compassion towards the residents, and that goes beyond the pay rate and the benefits. They still have to take home enough to support their families. This is just a little bit of history. Like I say, if you've been to my previous briefings, this is one that we just keep updating, and the rate increases, both in maintenance fees and entrance fees, as we see, we try to keep up with what's on the previous slide with rate increases for our revenue coming in from the residents. This one is a kind of a real telling slide. You can see we're in the red line where we've raised rates, and 5.8, 5.8, 4.8. This last one was 4.5. Yet our core expenses, as reported every quarterly on the EMA reports, have taken off and are still out above where we were in 2022. So there's still this gap that we're looking at. And as far as monthly service fee increases, the one we just went through in September at 4.5, and you see some comparables there, folks around the community, around the nation, who are for almost 99.99% open eligibility. So we have to compete with all those folks in many different levels, and this is one of them. Okay, so operating rate history. This shows the losses over the last 11 years, many years out there. Almost every year was some sort of a loss, and that's that operating rate over 100. And those are graphed out here. As you can see, they've kind of been all over the board, different things happening, different years, and improving the last three. Then another question we also get is, well, everybody watches the independent living occupancy at the ARC, and how does that compare with nationally? It's we're off national. What would that be? About 5 points at least, a little more from the national average. Assisted living pretty strong. Skilled nursing kind of right in there in that neighborhood, and the CCRC overall we're off by about 4 points there, as far as how we compete with the whole national of the United States. This is our history. Can y'all see those well enough? No? Well, it's 88 across the top, and with 89 and 24. And then the other components have improved over time, with assisted living coming up and SNF coming up. And what I can see about that is, what I would say is that as sometimes people age in place, and that's something that we encourage, but sometimes that really isn't possible, and they move through the continuum to need more care. So as the community gets older, we need higher levels of care, and those other higher levels of care have a higher occupancy. We go to the next slide. Now, kind of switching gears a little bit, looking at new entrances, new people coming into independent living. You can see all the way from 47 down to 21 through COVID, back up to 43 and 24. Last year was not a very stellar year, a real challenging year with only 22, but we're on a course to beat the 38, I think, at least match it already with folks that have already come in, folks that are committed. So we're going to be in the 30s. We're in the 30s right now. We're only halfway through the year. So I believe, then what does that mean? That means money coming in, millions, and it varies by year, of course, but that all comes to the bottom line. It pays everything from the bond debt to the capital expenditures to everything else that we pull out of on the capital side, the refurb is a big expenditure. And as you can see, budgeted back up to that 12 million mark at the very end. This is a real good news story. You can see where we budgeted occupancy this year in 26, and then where we are now, which is nicely out above that number. You can see the red line coming up, approaching 90. I'm not sure whether we'll get to 90 in the short term here, but we're going to push it real hard. We're almost there right now. And what I always have to say is that's good. People are always moving in, but people are always moving through the continuum. They're always passing away for some reason. I'm not sure what we're doing wrong at that point. We'll have to maybe change some policies. We'll take it to the board and see what they say. So then what happens with one additional entrance fee? You can see where unit turnover to get that unit ready is a big expense, because a lot of times people will move out, move through the continuum, and they've been there for 30 years, so there's a lot of improvements that we need to make to that. Turn it over, literally. I grew up on a farm, so I know what that looks like with a plow. They don't use plows anymore, but that's a pretty good way to turn things over. That's a pretty good way to describe this. Sometimes we just have to plow everything, turn it over, and redo everything. So that's expensive. But out of one new entrance fee, then we come up with about $115,000 on average, what we project for this year, and that's based on what we did last year. So it's not too much pie in the sky. And as you can see how that compares to one-day cash on hand. So one additional entrance fee is very meaningful to the overall success of the ARC. Now, this is a little busy slide. It's really tiny, and I did that on purpose. See if anybody can read that, let me know. We have a special job for you in accounting. And size font 4, I believe. No, it's about 12, but it's hard to see. But what this, I'll try to talk about it, okay? It's the net entrance fees so far this year, and what that means is we have, let me see if I can see it here. We have almost 1.4 more cash come in this first quarter than what we had budgeted for. So the success of having 12 unit sales instead of 9, we budgeted 9, we had 12 come in, new entrance fees. That translates into about $1.4 million in extra cash coming in, and much needed to replenish our reserves. We go to the next slide. And then this is a little bigger, maybe hopefully you can see this. What we had reported out this last EMMA report, and we had our operating, because of those numbers in the previous slide, and that higher entrance fees helped us quite a bit to come in at 96.5 as far as the operating. So we're running at a profit right now. That's a little rare. We didn't budget for that. The budget for the quarter is 103 and 7/10. And the way the budget works, it's fairly heavily weighted to the first quarter as far as expense, and then as we go through, we have more rate increases and things that come into the later quarters that help us get back to the 100.5 where we budgeted for the whole year. So this is just the quarter on this slide. Very good results. And then just some even smaller print but these slides will be in the library, they'll be online. But basically, this is a variance report. The big mover here is the TRICARE and Medicare revenue over census and over budget by $206,000 in the quarter, because we're running about 28 per day, 29 per day, folks on those levels of care, and we budgeted 21.5. Every year over the last several years, we've bumped that number as far as the budget, but it's a little bit like a gas pedal that you can't, once you budget that number, there it is. And so you can't, throughout if that were to come back down as far as the actual, there's the budget at 21.5. So we have to be careful to over budget, over expectation on revenues. One thing I've learned over 30 years is revenue may or may not happen, but expenses surely will. And so you've got your water and electric is helping, dining is over a little bit on labor. Let's see, information services a little bit under, and then direct Medicare with TRICARE is over as well. That those two track together and are related, because every time somebody's on Medicare or TRICARE, we have to spend more money on rehab and pay those people that do the rehab, and that becomes a direct expense along with the Medicare days. If someone's just in nursing care, we don't have either one of those. We don't have the higher reimbursement rates that go with Medicare. Typically, 500, 550 in that range, pretty close with TRICARE. But then we also have much higher per day expenses on those same levels of care. Let's go to this next slide. This is capital through this past quarter. And you can see we're not quite at 25% of the entire capital budget, but we're pretty close. And the major piece being unit turnover, as we talked about earlier. Other things that come through, air conditioning, HVAC is always a big expense. And then some other pieces of repairing everything that might not be working anymore. And we have, a lot of times we get questions. These are a lot of the same slides, for the most part, that I've given to the board, presented to the board at some point along the line. This is brought up to date as far as the Frost investment accounts. Where is most of our day's cash on hand? It's invested in Frost. And two different accounts. The original account has been there since about 2020 when we moved money over there from other various accounts and consolidated it. And as you can see, there was a withdrawal in July to make bond payments. And that typically is not the best, but it does happen. And then the ERC claim funds, and I'll talk about that a little bit later, that just recently came in, claim clear back from COVID days from first quarter of 2021. So that money finally came through from our friends in Washington, and they're good friends as long as they keep sending $2.5 million every time they contact us. So if they want something else, I don't know, we're not available. They'll have to get through Kelly and talk to her before they talk to me. But, you know, if they're sending a check, you know, we're really glad Steve got that check, actually. He found it in the mail, and Emily, so we're very proud of that. So anyway, so we'll talk a little bit more about that later. Then those funds are invested. And like I say, both accounts together at 60s equity. 60-40 is the plan. The board just approved that adjustment to go to those levels from what they were before, a little bit different. They just approved that in September. Frost's been a great partner for us to get those investments where we want them. And then the insurance settlement account, which I'm sure we talked about it before, but back in 2016, there was a bad hailstorm. We sustained a lot of damage. My predecessor and Dave Fulbright went to bat with Philadelphia. Philadelphia said, no, we're not going to play ball. We're just going to send you $5 million, go away. No, actually, they said the first offer was $1.3 million. And they wisely said, no, we got a lot more damage than that. Ended up in court, ended up in a lawsuit. And I can't take credit for myself, they hired one of the best firms in Texas that typically what they do is they sue insurance companies to get money out of them. And if they aren't successful in the beginning of the lawsuit, they go all the way to the Supreme Court, and this particular law firm had won several times at the Supreme Court for quite a bit of money. So at some point, Philadelphia decided, well, this is not a train we want to keep riding. So we ended up with about $13.7 million out of that total after the $5.5 million that came through to actually fix the roofs. Many of them were composite all over campus, especially on this side of the campus, and replaced with metal roofs. And but the damages were all over, so that's part of the claim. Anyway, so that money's been invested. Until September, it had been primarily in bonds, and they've been growing kind of pedantically, slowly in bonds. And looking at the overall market and what we plan as the future of the ARC, it made more sense for the board and for leadership to put that into a more traditional 60-40, 60 equities, 40 in fixed assets, bonds and other fixed investments, which is a typical split for nonprofits, for other companies like ourselves, to have some risk, but not an inordinate amount of risk. Frost has done a good job of investing in, especially on the equity side. They are primarily in exchange-traded funds and track the stock market. If the stock market does well, they do quite well, as you see here. And then on the fixed bond side, some of it is in treasuries, some of it is in corporate bonds, some of it is in basically exchange-traded bond funds, if that's even a term, don't quote me, but what that looks like is to have a better return on your bond investment than just buying a particular bond. There's only part of that money that's in individual bonds, because an individual bond you may take a loss, 100% loss. But if it's in a conglomerate fund, one company reneges on their bonds, has problems, everybody else pulls together and they still get a return. So it's very good return for us, and a good partnership with Frost. Then another question that comes up from time to time, you'll see it on the financial statements. Well, okay, we have bond debt. Well, what does that really mean? As you can see, there's 3 different series active right now. The older bonds are paid off. There was a 2002 bond, there was a 2002 bond, there was a 2010 bond, there was a 1998 bond. If you go back through the financial statements, which when I started, I looked back quite a ways, and then I've been busy since, but I looked back quite a ways, and all the way you can say definitively that almost from the start, we've had some sort of debt. We didn't build this building without some sort of debt, bond issuance, and so there's bond issues clear back to the beginning of the ARC's time. But these 3 in particular are still outstanding, and we'll explain a little bit more about them on the next slide, but you see the different interest rates and the amounts that are out there, and when they mature. So send me a letter in 2057. Let me know how that goes. I'll be 99. Now, at the bottom is another number that comes up on the Emma. My friend Emma, she's great. But it's a lot of good information from Emma. But somewhere out here, actually in the year 2045, these interest payments and bond payments hit the max. Now, bond schedules are set up, and bond payments, bond issues are set up so that there's no particular year where it spikes up and that's be hard to make that payment. It's all kind of level, like you would do on a house mortgage. Your house mortgage payments are level all the way out to the end. With bond issues, even with multiple issues, our friends in the bond industry work that out to where there's some bonds out beyond any other bonds, and then there's interest rates in between. So your maximum annual debt service is $8 million. But this year it's not that much. It's a little bit short of that. And most every year it's short of that to some degree. But at some point you've got to keep it around $8 million. And then all the way out to the end, when those 22 bonds mature, it starts to go down. Those are the only bonds. After you get to 2045, there's, what would that be, 12 years, where the 22 bonds are paying off in those years, actually. Next slide. So, question that came up just lately, well, why do we have this debt? Other than it makes for good reading on the Emma, we have the 2016 bonds, 2018, 22 bonds. So let's start with the 2016 bonds. Those were a refinance right before I got here of the 2010 bonds. Now, why did we have the 2010 bonds? Well, we had the 2010 bonds to finance the cost of everything that went on the other side of the bridge on Lakeside. That was one of the major bond issue for that. And I think that started out as almost $60 million at that point. Then, as we move up the slide from bottom to top, you've got the 2012 bonds were issued in of course, that year. But there were cost overruns across the bridge of up over $20 million. And so they issued more bonds at that point to cover all the costs. Because big projects like that, I've been involved with them before I came here and other places. Sometimes cost overruns are just inevitable. Sometimes they happen. But what do? You can't really stop when the barn's half built. You got to continue with the housing. What do you do with an assisted living building that's only half there? So you had to finish it, and that was those bonds in 2012. Then in 2018, this is the first bond issue here that I've been involved with when I came here. 2018, we refinanced those to get a lower interest rate. Got about $200,000 a year that we saved on that. But you go through the whole process, and it's an advance refunding, is what they called it. They've since, in about 2019, that whole provision went away out of the bond law. You can't do that anymore. But we got in there just at the end of it, end of that provision. We're able to refinance all the debt that was outstanding at that time and then bring it forward with a lower interest rate. But that's about $21 million that's on the books right now. Then the latest issue is the 22 bonds, which financed everything that you're seeing here and all through the high-rise, every single floor, the Sky Lounge, and the kitchen was a big expense all the way through, the dining room, everything all the way through it, plus 46 apartment and legacy cottages. And that came along, obviously, we're just 2 or 3 years into that. At 25 right now. Let's see. So recently, we had some good news from our friends at S&P. Sometimes they're not our friends, but this year they were our friends. Last year they were very friendly to us, and they upgraded us in a slight sort of a way. We're still at BB+, but last year, going into last year's rating, we were negative. And I always have conversations with these folks. Steve does, marketing does, Terry, in those conversations. Why are you negative? What's the story? Okay, because we have a very positive story. And through adversity and through different things, you can see on the entrance fees up and down, we've prevailed. We're now running below 100 on our operating rate. So why do you think we're negative? Well, they finally caught on to that line of reasoning. And last year they bumped us from, it doesn't sound like a whole lot, I make a big deal out of it. But anyway, we went from negative to stable, which means, we're not going down, we're not going up, we're just holding level. It's like if you were in water, what would you want to be? You'd want to be stable. If you had water up around your neck, you'd want to be at least stable. And then sometimes that's the way it feels. But you can see the things that they've said about us. They complimented us, yet they have kind of a yin and a yang about the whole thing, about what they say is good and what they say is bad. And then if they say something is bad, they say, well, it's not as bad as we think it is. Days cash on hand dropped this past year, but it's still a rating strength because we have days cash on hand. And compared to others in our rating score, BB+, they compare us all the way across the board. So S&P, they're a big outfit. They do a lot of this. And this was a good result after the lower entrance fees, which you saw in one of those earlier slides of only 22, coming back to being stable, because we thought we might go back to negative because they didn't like our results. Meanwhile, we were able to talk to them about the expanded marketing and media management, which actually really caught their attention as a future potential, and to sustain the entrance fees that we've had, especially in this first quarter of 12 over 9, as we talked about earlier. And we're looking at maybe even better numbers this quarter. We're not quite there yet, but in December to have a very good result as far as entrance fees. So all that we were able to communicate that to them, and they came back with a stable outlook for another year. Does this cost us money? No, it doesn't cost us money. If this goes up and down, it doesn't have anything to do with the interest rates on the bonds. The bonds are out there, they're fixed rates. They could say we're great, they could say we're terrible. Our bonds are out there, the bondholders are getting the interest, and it just goes on. Where this would have an effect, and is very important if we ever do another bond rating, we want to maintain, or bond issuance, and then the bond rating comes into place, because wherever we rate as a BB+, and what the outlook is, then they price the bonds, and do we get a good interest rate? Do we get a much higher interest rate depending on what the bond rating is at the time? Go to the next slide. So what's that translate into? We have dollars here, and they're small, but they're not that small. They're millions of dollars. This calendar year, about coming up with almost $8 million in bond payments. Interest runs every day, and we pay it 6 months. And then every July, we pay off 2 bonds, one of the 2018 bonds and one of the 2016 bonds. And we pay off one of those bonds every year. Now, the 2022 bonds, they're interest only out till about the year 2045. And then they all come due each one a year after these other issues are paid off. So that's why it's called a wrap when you do that. The total, as we pay this, it'd be 72 days, equal to 72 days cash on hand. The thing is, it won't hit us all at once. We have some coming up in January. It really looks to me like we'll be able to make those payments without drawing from Frost. That's been a really telling point over the years of whether we had to dip into our reserves to pay the bond debt. So we're having a good quarter, a good 6 months, and we should be able to make these interest payments without pulling into the Frost reserves. Then just a little more bigger picture of what happens at the Ark as far as cash flow and in and out. You could look at it this way as far as entrance fees, what we budgeted for this first year. This next year is 38, and entrance fees about 12 million, and operating gain, which we don't talk about it too much, but it's there for sure. The actual what we do at the Ark with monthly service fees and assisted living, Medicare, TRICARE, everything else, all the way through, we do make money. And we have a margin, and there's the margin for this year. And then we get further down the page, we'll see what happens to that margin. But the investment gains are positive so far and projected at 6. Maybe I'm hopefully projected too low on that, but those are the projected cash flow coming in this year to the Ark. And then where does it go? Well, a big part of it goes to, as we turn over units, we've got to get them ready. Nobody wants to move into a unit that hasn't been updated for 20 years or 10 years or 15 years or whatever. As you go in the commercial in the outside real estate, residential real estate, it's really hard to sell something that doesn't have a new kitchen, hasn't had some updates. So it's the same situation here. To attract new residents, we have to have something attractive to attract them to. So that's where those expenses come through. Then recurring capital, most of that is some sort of HVAC related. Last year, we spent about $1.8 million on the chill towers, the chillers in the bowels of the earth of this building. They're down there. James will give you a tour if you want to see them, but it's better to take a helmet and maybe, you want to be careful. But they're big and they're monster, and they run all the cooling tower water through this building to either heat it or cool it, and they're expensive. And they were original since 1987. They came across on the Mayflower, and they were part of the offloading at Plymouth Rock, but they don't ever talk about it in history books. I think it was just too obtuse. But they were old and they'd worn out. They run 24/7, 365, so they had a lot of hours on them. So they're new, and that's one of the big expenses that we had last year. This is just normal things coming along as we replace air conditioning and every other type of system throughout the entire campus. Then the next one, bond interest, offsets directly. You can see it's almost the same number, really. It's 50. We had operating gain of 5.4, and then bond interest is 5.6. So that's where we end up. If you remember the budget presentation, that's okay if you don't. We had about a loss this year, operating of about $201,000. That's that difference, is those two together. Then every year, like I mentioned, we pay off 2 bonds, and there's a $2 million bond principal. So, negative net cash flow. That's not a real good number coming from a CPA. I don't like that number. Nobody likes that number, but that's the number. The way to change that is in the short term is more entrance fees, more people moving into the Ark, higher occupancy, higher monthly service fees, all the way through that. That's short term. Long term, the solution is more entrance fees. In my mind, it's exactly the same thing. We need to be at 50 or 60 new move-ins. It takes about 40 every year of new move-ins to replace the people that either move through the continuum and then they pass away, or they pass away directly out of independent living. But we have about 40 vacancies every year on average. Takes several years. So we need 40 new residents, new occupied units every year just to break even. So we've got to get north of that somehow. Next one is real good news. Leaving that till last, of course. We talked about it a little bit earlier, but what's this employee retention credit? Well, it's really a leftover from COVID, and it was an attempt by our friends in Washington to put money out there to employers to help them keep people employed. That was also the base motive, the ulterior motive of the PPP loan that we got several years ago. That was a loan that we had to maintain our employee numbers, and that eventually was forgiven. It was for $5.6 million, and that was eventually forgiven. So we just got to keep that money. This money is just straight out, just a big check, just comes in the mail. they're very complicated. I looked into it and I'm like, okay, yeah, whatever. Calculations to figure out whether you actually earn this money from the regulations that were put in place by people like me and helped by attorneys. And they put regulations in place such to the effect that if one of these quarters directly affected by COVID, we could show reduced revenue for whatever reason, and the revenue was reduced because of everything that was going on with the COVID disruption. And so we qualified in the first quarter of 21 for that. Now, I also got a lot of calls, a lot of emails, a lot of texts from everybody and their brother who thought they could calculate this for us. They want 2%, they want 5%, they want 10%, and all you got to do is let us do it, and it's wonderful, and we're, and just send money to the Nigerian prince at the end of the day. So I didn't do that. We didn't do that, and we reached out to Clifton Larson Allen, which is one of the, I think if they're not the largest, they are the largest senior living accounting firm. Every year they contact me. Every time we're up to get a new auditor here, they want our business to be our audit company. I've never hired them yet, but in the past I've worked with these same folks. Where I worked in Dallas and where I worked in Abilene and Austin, I worked with the partners from Clifton Larson Allen. So I knew these guys a little bit from that background. They're a national firm, very sturdy, stout reputation, and so we hired them. It's expensive, but it's not on a percentage basis. And we've already paid them half of those fees, and when we get all the rest of the money that's due to us, another $1.9 million, we'll pay them the other half. That's $569,000. So yes, it was expensive, but it wasn't a contingency basis. CPAs can't work like that. It's against their ethics. Not saying anything about anybody else and their ethics, but CPAs can't work like that on a contingency basis. So just a straight fee, and we, in November, got a nice big check for $2.6 million, which represents the first of the 2 quarters. Now, what we didn't really expect, we'd heard rumors of it, that people were getting interest on their money. Okay, yeah, sure. But the original claim was about $2 million, plus we got $635 interest, which we were not expecting, because other people that I've talked to in the industry, and Close in San Antonio, sometimes they got interest, sometimes they didn't, and they really weren't. Nobody really wants to figure that out, nor ask too many questions of the IRS. And why did you send us this money, other than thank you, and we're very glad. Have a nice day. So we don't know whether we're going to get interest on the next $1.9 million there you'll see in the middle, but that claim we expect to pay soon because of the first one paid. The second claim was the one that earlier, couple months ago, we got an audit request. It says, send us your documentations. So we did. I sent some to Clifton Larson Allen. They sent the whole package, about 100 pages, to the IRS. So we're still waiting on how that works out. The other thing that's really quirky about this is just the way they wrote the law. If you qualify for 1 quarter, like we did the first quarter, 21, you automatically qualify for the next quarter. It's like Merry Christmas. So I can't say it's a totally done deal, but because we got the money for the one that's where we had to qualify for, the next one is just automatic. It's right there in the law. It says if you get one, you get the other. So we're just waiting on this other check for about $2 million to come in. Well, what does that really mean? We talked about days cash on hand there at the bottom. We talked about if we get all this money, maybe we'll get more. We get interest on the second claim. We're looking at 37 days cash, which will help us, obviously. And this is my last slide. It's a little bit of a hard picture to look at. It's our days cash on hand clear back to 2017. They've gone down every year. And what's the equation on that? Well, it's entrance fees, not having enough entrance fees. And you see how they went down to about 2022. That was COVID days. Then what happened in 23? We got that insurance settlement of almost $14 million, that nice big arrow to the sky there as far as the graph is concerned, back up to 428. And then they've been drifting down since with entrance fees not sufficient to cover everything. And then as you see, this last quarter, we dropped to 271. One thing I didn't show on this is quarter by quarter. Throughout the year, even within this, as a subset of all these numbers, on a normal year, the days cash on hand builds throughout the year. Your lowest is going to be your first quarter. Then as more entrance fees come in, then you have, it builds throughout the year. You have this July payment, which we absorbed because of the entrance fees. But it's a big hit. That's $298, if I had a pointer. But the $298 and the $271 is one of the things that helped us. That looks bad. But it's not as bad as it could be, because the payment we made in July equaled about 46 days. So we would have been clear back down to 50. But what helped us come back to 271 were the extra entrance fees and the strong occupancies in assisted living and nursing. So we're at 271. So S&P looked at that and said, well, okay, we're going to leave you at a stable rating. You're able to absorb some things, kind of the shock treatment a little bit. You've been through, I hate to use the term for this folks, but a little bit of a battle testing. It's not really. It's a little more of a, did you fall out of the pickup as a little boy and your dad just drove away kind of thing, and more of a situation like that. Now, that did happen to me, yes. I was about 12. He came back, get me, but it took him a mile before he realized I wasn't back there. We were on our way to round up some cattle, and I fell out of the back, and so I started walking onto the pasture, which was a mile away. He got there, realized I wasn't there, came back, and I got my behind chewed for falling out of the truck, which I wasn't supposed to do because that's dangerous. Okay. Well, now they don't even let kids ride in the back of a pickup. I'm like, come on, people. You know, the things, all of us, worst things that you all went through growing up, and things you grow up with on a farm you don't even think about. Falling out of the hay mow. Oops, yeah, there's some already processed hay below you, and so you have a soft landing. But other things that happen that you just grow up and go on. But back to my story, which was, I think, if I forgot, the 335 is where we quite possibly could end up at the end of 26 with the ERC money. If we don't do that, as if when I first budgeted this, we didn't know we were going to get the money maybe forever or soon or maybe next year. It's kind of like talk to the IRS, they'll tell you. It's in process. But the original cash flow that I put out there for the board, for everyone else, has us staying, and you saw the slide earlier, it's a negative 42,000, basically staying in that 298 days cash on hand range with a goodly number of entrance fees, 38 compared to the year before at 22. So it just comes down to that. You can see where our friends in Washington helped us on days cash on hand. They're helping us again. But the trend lines are not the best to present to anybody, and especially a group of y'all who are living here. So, but there they are. And with that, I think that's the last of my slides. Now, we'll go ahead and open it up for, I don't really have any closing comments. Like I said, I didn't have any prepared comments to begin with. So unprepared closing comments I don't have, other than thank you. And I just have to say I'm so very glad to work here. I've worked a lot of places where we didn't have this culture of not only the military culture, but the culture of the employees of looking out for one another. A lot of for-profit companies, they talk the talk about their culture, and they're all for the residents and everything else, but they're all about the dollar bill. And somebody like me gets put in a position of pounding on, beating up the directors, individual directors of the individual departments when they're over budget by $50, and just a totally different culture. We watch our expenses very tight. There's one of the ladies back there, Debbie, who's done great work since she got in that position to cut our expenses and rework some contracts and really done a great job that way. And you've seen the slides. I didn't bring one up. It's Cindy's slide about the costs that we've cut over the years just recently, about $500,000 in things that are just tangible right there. So we work very hard to keep our costs down, but at the end of the day, everything that we do here stays here. Whether it be good or bad, it stays here. There's nobody coming from the corporate office to take our money, but there's also nobody coming from the corporate office to bail us out. So whatever we do here is our own responsibility and our own problem or our own blessing, however you want to look at it. So with that, we'll open it up to questions, and I'll get something to drink and maybe have some questions.
Gordon, thank you for your presentation, first of all. You talked about the cost of rehab of new units and talked about what is the difference in pricing our cost of the traditional plan versus the campus development unit?
Well, it averages about a little over 200, but the average is between, you've got, the traditional will run from 80 to 100 to 120, and the CDP units will run over 300.
So are we still trying to sell in the traditional plan sometimes? Because at one
Yes.
point, I was told, well, we're not doing traditional plans, we're only doing campus development, but that will save us some money. I know we want to have nicer units and everything, but not everybody wants that. And I guess my question is, are we marketing traditional plans?
Yes, we are, yeah. As each unit comes open, someone moves out, my department gets together with marketing, and we look at the numbers on what that's going to look like, whether we take it to a CDP level or a traditional level, how much work it's going to need. Sometimes, depending on how long someone's been there, I mean, talk frankly, if someone's been there 30 years and it's kind of needs a lot of work, it makes more sense to bring it to a CDP level, because CDP level means everything goes, everything's new. If it's a little better shape and it's a smaller unit, maybe we'll take that to a traditional because the refurb is less. Some of those are 50, some are 80, some are 100, 120, sometimes more for a traditional, but that's still a pretty good refurb. It's like we used to do, if we can remember what that was, and before we had the CDP units to sell. And the correlation is a much higher entrance fee on the CDP units, much higher cost structure, but a much higher entrance fee, and a lower, we've got these two at CDP, okay, whatever. And then you have these two at traditional. So we still have to have a margin after we refurb to have entrance fee margin over what it costs to do that. We still have to make a profit on that. It's not really a profit, but we have to be able to cover that money that comes in, goes for everything else that we have to pay, like bonds and capital improvements. We can't have that upside down, very few, if ever. Okay. Another question?
Thanks indeed, and especially thanks for that increased office bandwidth, particularly appreciated. A little niche, I went through it to change the documentation so the payment, when I leave, pass somehow or another, was going to go to, quote, the estate, which could have triggered probate. We now have in place a paperwork that it goes to a trust, which is appreciated. But it took, doing it secondarily, took a fair amount of time, mine and the office's. My question then is an incoming resident, given the question, do you have a trust, and then the dominoes fall, is it the appropriate trust, and here's how we document it. If not, could that process be in the checklist? Could that be considered?
I would say yes. A lot of those things come through the process with marketing with us as far as getting to the final entrance fee signing. And typically folks will bring that up. I'm sure we could do a better job with ferreting out that information. But a lot of times people make assumptions about the entrance fee, but we try to explore that. Is this going to go back to your state? Is it going to go back to your family? How's it going to work? Because it's much easier, because after the fact, it's very hard to get that done and beforehand. So I would recommend anybody that has a trust to come to us and gets a new trust or has one in the past, come to us and make sure we have the, it's not that hard to get the proper documents in place, but we have to know all the facts before we even draw up the documents.
I would just advocate that be a part of the entrance process to identify those with trust, ask the question, and I think it would be actually time saving in the long run.
No, that's good advice. We'll take it for sure. Thank you.
Could you talk a little bit about...
Thank you, Gordon, for being here. I'm Missy Denny, and I'm the chairperson of the the special, resident council special activities. In the grand scheme of things, this is a very small question. But just recently, we're getting ready to do the New Year's Eve party. And I was told that we wanted to upgrade our meals to justify the fact that everybody gets dressed up and comes. And we didn't want a $20 buffet. So I was informed that in that case, $20 would go to food, to dining dollars, and $20 to go to house account. I need to know from very people ask me that, why can't all $40 be on dining for dollars? Because if they go over dining in dollars, it goes on the house account automatically. Can you kind of give me some heads up on why we have to split that fee?
The basic answer is that as we do one meal and we go out and above for that one meal, not everybody's going to come there for one thing. And the $20 a day is for that one meal a day, which people get in a bistro, they get other places. So we've done the special meals as a split, so the folks that want to participate are sharing in the much higher cost per the meal than just, for example, we're not making money on that. I mean, so even at the way you described it. But the part of the overall philosophy with dining dollars is that it's shared amongst everybody, and when you do something extra outside of that paradigm, outside of those constraints, then it becomes more of an ancillary in that those people that want to do that, and they will, and they'll sell out, and those folks should pay a little more for that than just everybody else who doesn't want to participate. Is it fair for everybody to pay for all the costs and they can't even get in? Maybe it's full. Or for those people that want to do that, and we'll cost share with them at that part of it dining dollars and part of it as house account to cover our costs, because not only the food, it's the extra labor we have to have. Also, I mean, compared to a regular meal, it's very expensive for us on our side. So a lot of it comes down to fairness, and I know this doesn't resonate very well because it's hard to explain, well, dining dollars anyway, but it's only a 2-page policy. But so the main issue there is fairness, and that people that want a meal and they're paying their monthly service fees, that's part of what they're getting as part of that. If they want to go to the beauty salon, is that for everybody? No, probably not. So people going to the beauty salon, paying extra for that. People want transportation to a special event, they're going to pay a little extra for that because not everybody's doing that. So it's more of a, if you're in for everybody and it's spread evenly across and there's a fairness quotient, if you're doing something special, well, then that's fine and we'll support that, but not at the expense of what it costs for everybody else's. Because at the end of the day, I had a slide up here, at the end of the day, everybody gets to buy into the rate increase. And if we cover everything, that's an expense that's out there, that's possible, okay. Then that rate increase is not 4.8, it's not 4.5, it's not 5.8. It's significantly higher than that because you have to spread, that money's got to come from somewhere. It either comes from everybody, and a select few get to be in this particular activity, and they get special and it's free for them, but not everybody can do that. Maybe not everybody wants to do that, nor are they able physically. So it's kind of to me, it comes down to a real basic fairness issue, that we do a lot of things with dining dollars, but we don't do everything. Okay.
Could you talk a little bit about corporate sponsorship or corporate donations and the ARC?
I'm probably looking at someone else who could do a better job of answering that question. There's a whole development committee that works with corporate donors, potentially, and we've had good participation in the past, for example, with Phase 1. Part of the money came from outside the ARC. Part of it did not. Most of it actually came from inside the ARC. We raised about $4.1 million, and about $3 million of that, and don't quote me on these numbers, but I'm pretty close, About 3 million of that came internally, but about a little more than 1 million came from outside the Ark. Isn't that about right, Steve? Yeah. Okay, so in the past where we've had a campaign like that for phase one, which we did, and we raised outside money, we raised internal money. So it's not like they're not out there. It's just to really get somebody to donate to the Ark, it really takes an active campaign for something specific that they're going to give money to. Ending with a preposition. Thank you. Do my best. Got a question back there?
My question.
Oh.
My question is, what does the budget look like next year if we don't get the ERC money?
Well, we got part of it already. We got 2.6. The other would be coming in at right at 2. I didn't budget for that this year. I'm not going to budget for it next year. It's been going that much that we already got. Went into the frost account, went into reserves, which is great. That's budget to have it in there. It's 37 days cash if we get it all. But I'm not going to. That doesn't play into the budget because it's a. Well, we're very lucky to get it, in that it's replenishing the reserves that we've had to take out to make bond payments over the last 12 months, especially. So I don't budget for things that I can't really nail down, which I can't with that. So.
Hey, Gordon.
Yes.
Healthcare costs and reimbursements and all that kind of stuff. I heard you talk about Medicare costs and TRICARE reimbursements, those kinds of things. With the advent of all of these Medicare Advantage plans and the advent of folks coming in that don't necessarily meet the TRICARE Medicare or TRICARE for Life Medicare thing, what kind of an impact, positive, negative, or whatever, has being able to tap in, use those programs, what kind of impact has that had financially on us, if any?
I mean, like the Medicare Advantage?
Or, I don't know, teachers union or, truck drivers union, whatever, their insurance or their plans. What kind of impact does that have on being able to pay the bills for folks that are here that use those and depend on them?
Well, as we've developed a pretty good system, as systems go, with dealing those as a one-off, but we focus when that person needs, let's say somebody, because anybody in here could switch to a Medicare Advantage. We highly recommend that you don't. I had the option to put my wife on a Medicare Advantage. She's 69, bless her heart. She's 2 years older than me, so when I was 38, she was old. She was 40. She she didn't really appreciate any of those comments, so she's not here today. No, with Medicare Advantage, we really have to treat it as a one-off unless we're going to get contracts with dozens and dozens of companies that are out there and options. Some people do that. As if you're in the commercial nursing home business, it behooves you to get as many of those contracts as you can because you're trying to cast a wide net and get everybody out there to come in, and you're going to deal with Medicare Advantage. With us, we don't particularly want to do that, but we will. We've worked through the situation with several people over the last year where once we know that they have Medicare Advantage and they need to come back to the community, we work double time. David Callahan in nursing goes to work. Lisa goes to work. They work on getting that person qualified. And many, if not most, of the time, we're able to get a pre-authorization and we can get reimbursed from that Medicare Advantage. But if we don't get that pre-authorization, they're really built like an HMO. If you don't get pre-authorization, too bad, so sad. We're not going to pay for your whatever you want back when people are younger. In Medicare Advantage, the reason those are so popular and so advertised so thoroughly to even like my own family, they're profitable. Humana makes all kinds of money off of that. Well, what do? They take what the government is willing to give them for each life, each person that's on that program. They get a set amount of money for their age and to a certain degree their condition that comes on. And then they manage to keep their expenses as low as possible within that framework of reimbursement of the total. But that particular person, Joe, Joe Schmo out here, he usually takes a beating because they're looking at kicking him out of the hospital quickly. They're looking at getting him out of SNF quickly. We have to work it really hard, but we've done a good job of getting coverage for those folks, but they're all on a one-off. And so I don't know that I can't say that it's had a negative effect on the overall reimbursement levels and accounts receivable, but it's made each one of those is a lot of extra work.
So what kind of impact do you have on that as it comes to eligibility?
Well, our recommendations in the contract and requirements won't change with different eligibility. We still will expect people, and they have to have Medicare, they have to have another payer source. Maybe they don't have TRICARE for Life, but they may have something else. My wife has Medigap coverage from Humana, but she has Medicare A and B, and I learn more about that every day at home. So the Medigap is if she goes to the hospital or she has other and it'll fill in the copays and everything else like that. So those plans are out there without Medicare Advantage. They're to fill in the differences and the shortcomings of regular Medicare. So, answer your question? Any other questions? Got a question back here?
I'm back to the reserves. The most question I have about replacement reserves. Such as, why aren't we going to go ahead? I know dining points are, cost $1, and a lot of people do not use all their dining dollars per month. Am I correct in assuming that those unspent dining points go back into the general operating fund? Such as it's $1,200 and we only use
Right.
$840. The rest of them
Right.
go back into operating funds or replacement funds?
Well, those dining dollars, can you use them anywhere but here? You can't. They're dining dollars for use here. So
Right.
they're not legal tender. So they're not dollars that we could go back into the bank with.
Correct.
But the advantage of someone to the overall organization, I just have to say this, and there's even a memo from 2012, 2010 from Bruce Furbish, where he explains that the money that doesn't go into preparing those meals for you, the ones that you forego, the ones that you don't take, that money that would have been spent for those meals is money we don't spend. So does it come back? That's a kind of a broad brush, hard statement to say that it comes back. It just doesn't get spent.
Okay.
So it's money that doesn't go out. So yes, there is an advantage to the overall community, to the overall finances, if people don't spend all their dining dollars. But there's no account to capture those because, help me out here, good Lord, I'll call it a coupon. I've gotten chastised over that by calling it a coupon, but it kind of works like a coupon, all right?
Okay. What about
You, when you take a coupon to the store and it's expired, they don't honor it.
What about
But-
replacement reserves, such as the chairs in Water's Edge all need to be replaced? It's going to cost probably $36,000 to $46,000 to get rid of all those chairs with the broken springs and, the cushions that we all have to use on them. Do we have a replacement reserve for things like that?
We have a capital budget. We budget for those kind of things within a big picture of the capital budget. I don't budget per chair like in a capital budget or even for a project like that. I look at what we've spent over the last 10 years, 8 years, 9 years since I've been here, and typically we will spend X on those types of replacements. And that's what I budget for the next year with an inflation of typically 3 to 5%, that we'll spend that much more. So I budget in big buckets. Because what happens if you budget for specific things, you're going to need to do those specific things. But in between the time when you're budgeting for those specific things and you're implementing those, and you do those because they have to be done, unknown things happen. And you got to fix them right away. There's a leak, there's this, there's that, and you have to budget. So you also have to budget for capital on those lines as well. So we'll be able to,
But
we'll
how
be
do
able to
you-
do that when it
how do
needs
you-
to be spent.
I know. How do you say that? How do you do that? If you're going to budget for 10 replacement chairs, you're not going to just replace 10 chairs. You're going to have to do all the chairs at the same time.
Right.
One year, one of those times, it's going to have to, you budget, replace chairs.
Right.
What budget does that come under? I mean, how do you save the money?
That would
to
be
go ahead
life
and do it?
cycle, that would be life cycle replacement budget, which is,
Are those in life cycle? Are they there?
that type of thing is in that.
Okay. All right, so there is
Okay.
going to be some change, okay.
There will be money for those, there will be money for those things as we need them, as long as we have the money from entrance fees that comes in to cover those expenses.
Gordon,
Yes.
I have a quick question. I hope it's simple. When I go down your Emma report, there at the end, they have a listing of all the scheduled fees, but about 2020, the costing for assisted living and healthcare has dropped off. And I'm not smart enough to go into the language in my contract and figure out how to do that. Any chance we can get that back?
I can send it to you. I can send it to everybody in this room if you want it. It's
Well,
what we charge for different contract levels. That's a public thing that I share here. The reason I don't do it in the Emma, because there are so many different, it's really to keep what we do from a marketing standpoint from everybody else that's out there marketing against us to know exactly what we're doing, okay? They might have to mystery shop us to get that.
Well-
But I've got no requirement as far as the bond to disclose that level of detail that I can give. I know there's people in here that have gotten it in the recent past, just ask for it and I send it to them. It's what we charge, there's different levels depending on your old contract or new contract or your direct entry and what levels of care you are, because there's different pricing levels. That's a lot of noise to put in the Emma, I feel like, and if I'm forced to do that, I will, but I'd rather not do that just from a standpoint of, our competitors read that and they should have to mystery shop
Okay.
us to find out every single thing.
Understood, but in the past, there's been available,
It was much simpler then.
well,
In 2020, there was one contract. 2020, there was one rate. That was it. If you went into nursing, here's your rate.
well, they could,
Since then, we've expanded the offerings of both the contracts to the new contract, which came in July of '21. And then, since then, we've had a few. We always have a few every year. Every month, we have a few people who are veterans who come in at a direct entry rate, and those are higher.
but in the past, we've been able to get, I know it.
I can send it to you. I mean,
But I think,
I-
it's not just for me, I think it's for the whole resident amount.
that's available. I can send it.
Yeah, like.
I mean,
like-
it's
put
it's
it-
very,
put it- put it-
we have schedules for our folks who are working in marketing in those levels of care to be able to show as to a certain resident what their rate's going to be. And the rates are different.
So
If
you
you're an
could-
old contract, it's a different rate than if you're a new contract.
If you put
It's
it
just
on
that
the
simple.
portal, where we could get to it?
I'd rather just send it to you or the resident council. I mean,
Okay.
however you want it. Any other questions?
Gordon, I have a question, actually a statement and a question. The statement is, I live in the high-rise, and I don't have a garage. So from a fair treatment standpoint, I don't get any reimbursement for that. I don't have a yard, etc. So when you speak of fairness, be careful with laying it across the entire campus. I know it's hard, and I don't have a real beef about it, but it just is something that should be brought up when you talk specifics. As far as your opinion as a CPA, looking out the next 1 to 3 or 4 years, do you see any financial problems, serious problems for the art?
I always come back to entrance fees. I mentioned that earlier before. We need strong entrance fees every year. And we can't use monthly service fee increases to overcome that. You can see from the numbers. That's a big part of our revenue, but as far as cash for everything else, it comes back to entrance fees. We need them strong, high 30s to low 40s at least every year, and that's a weakness if we don't. I'm just echoing my own thoughts, what we've seen as far as the data, and also what our friends at S&P will tell you as well over their analysis of our financials over several years. They will say that we look great, but we, many other CCRCs, rely on entrance fees for a big part of our capital cash flow and bond cash flow. And they see that as a inherent weakness, but not so much of a weakness that they're going to downgrade our bonds as long as we keep getting entrance fees. That make sense? That's my answer. Any other questions? We're well over, I don't know where we're at as far as time. We're almost to 11:30.
Hey, Gordon, Lawson Magruder here. He was talking.
What?
Was there another question?
No, I don't think so.
For everybody in the audience, I was on the board for 5 years, on the Finance Committee for 4 years, and I know you miss me, Gordon. But I know the answer to this question, but maybe to educate the others. Talk about oversight, from auditing to finance committees to folks like Bill Klein representing the resident council and overseeing what you do day to day and how that dialogue goes, if you would.
Sure, yes, we have an annual audit by outside auditors. Their initials are ADKF. They're a local firm that's like one of the largest local firms in San Antonio, if not the largest. We have an annual audit, which we pass with flying colors every year. They also do the 403B reports for us, the 990 reports for us. They do them, and we report our data to them, and they make those reports with conjunction to, I approve them, and then they go to the IRS in the case of the 990s. But then above that and beyond that is the board's oversight to the Finance Committee, and the board, I report to them every time they meet with a lot of the same information, sometimes not as much, and at least into the detail as far as the day-to-day operations with the operating and capital and those other reports. And there's a lot of feedback as far as what they want to see, what they don't want to see. We've over the years we've evolved to what they want to see at their Finance Committee reports. And then as far as the board itself, they get the same reports with a lot of questions. We don't operate in a vacuum, and basically we try to respond to requests like we just heard one here for information that isn't normally out there, but it's surely available, and we can do that. So we try to be as transparent as possible and responsible as possible. It's hard to say. But I don't intend to do anything that is different than what I've done for more than 30 years as a CPA. If you don't have your numbers right, you don't have your integrity, you don't have your ethics, then why have the 3 letters? So that's my philosophy. So,
Gordon?
That's your question?
But I just want to say one thing. We do have some challenges. We really need to upgrade the healthcare center, and that's on the board agenda, and it's coming up. But the real challenge for all of us, and you have to take this to heart, we have to get the occupancy rate up. It's 92%, 92.5%, that figure fluctuates. We break even. 96%, we can do a lot of things, like maybe improve the Sunday brunch. No, I'm just teasing. But in my day, I've been here too long. We used to have carving stations and roast beef and all that kind of stuff. But anyway, we need to get our occupancy rate up to 96%. How do we do it? We're going to talk about that in the future, and you're going to have a chance to give a lot of input to it. But we have to do it. That's the goal. So everybody be thinking about it.
Thank you, sir. If there's no other questions, we'll wrap this up. We're about, okay. Here. Yeah, you can, I'll stay up here and people can come up if you want to.
You
Yeah,
spoke
the
of
question.
reserves. You spoke of dipping into the reserves when you had a negative cash flow. When will the reserves be gone, or how much is in the reserves? How many years can you go into that reserves? And the second part of the question is, if you don't get the desired occupancy up, what is the next step?
Well, there's a slide where we talk about 270 days, 271 days of cash, about 29, 30 million. We don't intend to dip into those at all if we can avoid it. But if we don't have the entrance fees coming in, we do have to make the bond payments. And we've seen that over the last few years where we had to dip into those. Meanwhile, they do grow. And meanwhile, we do have a profitable enterprise other than that. So I can't really answer your question with a date when, it becomes less than 271. I think we'll end up about 335 for this year with the ERC money. But the key to it always is what our entrance fee level, number of those that come in with the raw cash that boosts our days cash on hand and our occupancy is both. I can't predict that. I can't. Thank you. Thank you. Okay. All right. Thank you.